Hi, welcome to Control and Compound with Darren Mitchell. I'm your host, Darren Mitchell, and with me today is Christina Wyatt, a wealth coach at Control and Compound Financial. Christina, how are you?
Hi, Darren. I'm doing great. How are you?
I'm doing great. Excited to be here today. We got a real interesting topic that we get a lot of questions on. Question we get all the time is how much can I put into an infinite banking policy? Are there limits on how much I can put in? So, great point or great question. We talk about this isn't a traditional investment where you say, "Great, sign me up, I'm in. I want to do this." It's you really need to be approved, and when you need to be approved, we need to be approved through the underwriting process. So, Christina, let's talk about underwriting. What is underwriting, and how does the process work?
Yeah, so for underwriting, what we do to get you approved for the policy is we complete a life insurance application. So the life insurance application gets completed, and inside of this, you're going to provide medical information and also financial information. It's going to get sent off to an underwriter at the insurance company. An underwriter is an individual who specializes in looking at these applications and really mitigating risk for the insurance company. So at the end of the day, they're looking at all of these factors to make sure that you are a good risk for that company for putting this policy in place. So the underwriting factors come down to, like I said, the medical information that they're going to ask you, and then they're also going to ask on the financial side a few questions as well. That's what leads to this: how much can I put into the infinite banking policy? It's going to come down to that financial underwriting, which has a few different factors.
Yeah, so if you just think of insurance in general, think car insurance or house insurance. Insurance companies don't want to insure what you have for more than what it's worth. So if you have $1 million house, the insurance company is not going to allow you to buy a $3 million replacement policy on that. If your house burns down, they're going to pay you $3 million. Same on your car. They're not going to insure a $50,000 car for 200,000 and say, "Great, if you get in an accident, we'll pay you 200 grand." So the same thing applies to life insurance, and this is sort of just the starting point, the plain Jane policy. Forget about infinite banking, just a regular insurance policy. They're not going to want to insure you for more than what you're going to be producing. So if you're earning $10,000 a year and have no net worth, you're not going to be able to qualify for $5 million of death benefit. So when we talk about sort of step one, looking at income, what are the limits based upon income? And it varies by ages, but Christina, take someone like 20, 30, or a younger person. How much insurance is sort of the maximum the insurance company is going to look at before we get to step two and three?
So the insurance company has a table which they call the human life value, which is really taking that income and multiplying it by an amount that they feel you are going to make during your working career. So for a 50 or for a 25 to 50-year-old, they're looking at about 20 to 30 times their income, and that's what they're referring to as their human life value, as that's the income they're going to make over those years up until retirement.
Yeah, so which again makes sense. If you're making 100 grand a year and you're going to work another 30 years, well, that's $3 million that you're gonna bring in as income. So that's what the insurance company's kind of putting your value at. They're going to insure you up to that $3 million. And then step two and step three, we can get or higher amounts than that. So what about, you mentioned under 50? What about over 15, Christina? Does the amount of coverage you get change?
Yeah, so over the age of 50, they are going to start reducing that multiple. So at that point, we see a multiple of about 15. So 15 times your income, between 50 and 65, that's about how much they figure you're going to retire at 65. So you've got 15 years worth of income that they're going to insure for you with that death benefit.
Okay, but what if we have a spouse who's not doesn't have an income? So we have a spouse that's at home, not showing an income. Can we insure a non-income producing spouse? Because if you're making zero times 30 is still zero. Can we do that? Insure a non-income earning spouse?
Yes, we certainly can, right? The non income earning spouse definitely still plays a huge part in that family when it comes to their income. So the working spouse can get to work, right? So they are going to look at that as a factor for sure. And they do have a max though. So you're looking at about 500,000 that they're going to insure for a non working spouse without question. Sometimes they will go a little bit higher depending on what the family household income is and what's coming in. And that's something we talk to the underwriter directly about. But the standard amount is around 500,000 they're going to insure for a non-income earning spouse.
Okay, and what about children who don't earn an income, usually take part of your income? Can we justify an amount on children? Is there different rules for kids?
Yes, there are different rules when setting up a children's policy. So, you can't go ahead and set up a $3 million death benefit on a child. It just doesn't make sense because children don't have debts, they don't have income. So, there are some rules around that. So, they do typically, the standard amount is about 250,000 of death benefit on a child that you can put in place. Again, we can have conversations if needing more, but that is a standard amount. They also look at a couple other factors when you're looking at insuring your children. One of them being making sure that the parents have insurance. So, the first place you should have insurance is on the parents before insuring a child. So they're going to make sure that the parents have insurance. The second portion that they're going to look at is if siblings have insurance. So if, you're not going to put one policy on one child for a certain amount and then not on the other, they're going to have questions on that. They want to make sure that all of the children are insured equally, whether it comes down to the same deposit amount you might be putting in or the same death benefit that you're putting on the child. Now, there are certain situations where one sibling might not be insurable. And in that case, again, we can go back and we can have a conversation with the underwriter and explain those factors and let them know what's happening, why we don't have coverage on both kids. But at the end of the day, the answer is yes, we can insure kids, but there are a few different factors that we have to look at.
Yeah, and having gone through this personally, I always had some small policies on my children, and then when my son turned 19, I was able to put a much larger policy on him with a much higher contribution and death benefit. And the first question the underwriter asked after, how much does mom and dad have? And it was a lot. They asked, what about your daughter? Well, at the time, my daughter was only 16. So, the plan was, great, when my daughter turns this age, we're going to do the same policy. And it was just that conversation with the underwriter behind the scenes that we had. And they said, great, that makes sense. So again, they're not looking for a reason to refuse you. They're looking for a reason to approve you. We just need to, check all those boxes with respect to a kid's policy or any policy.
Yeah, the underwriters, they love their questions, but if you've got the answers for them, that they're great. Now, we talked a lot about income and how we use multiples of income in order to figure out the insurance amounts that we can put in place. We work with a lot of business owners. Business owners don't, a lot of time don't typically have huge incomes down on paper at tax time. What do we do for them, Darren? They're a little bit different.
Yeah, and again, it becomes much more flexible with a business owner. We could have a business owner, making $50,000 a year on paper, and all of a sudden they're doing a 30 or 40 or $50,000 a year contribution into an infinite banking policy. Well, if we just stuck with sort of step one, justifying it based upon income, well, that's not going to make sense. But if that business owner has other assets, has business revenue, has other income, and really the key on that too is liquid assets. In other words, the insurance company wants to know that you're going to be able to afford the premium. So if you're only showing an income of 50,000, but you have several $100,000 in assets that you can use to pay the premium, then we're going to be able to do a much higher amount than the income would justify on a business owner's. What else on the business owner, Christina, do we need to be aware of?
So with business owners, they are key people. So when we're talking to the underwriter, they completely understand that as a business owner in that corporation, there is a need for insurance regardless. If they weren't around the next day to run that business, to keep contributing to the business would suffer, quite obviously. So underwriters are very aware that business owners are key people. So they know that they're going to look and focus mostly on that deposit amount and being able to contribute to that amount to the policy, like you had said with the financials, and just adding that they're key people, right? That's how we look at it. That's how the underwriter looks at it when we're talking about business owners. Now, one other group that we work with that are a little bit different, just like business owners, are real estate investors out there, right? They can either be personal or they can be corporate in this sense. What about them, Darren?
Yeah, and again, just again, increase flexibility with real estate investors. With lots of real estate investors aren't showing a large income, or have a T4 job, or don't show a large income from whatever business they have, but they have real estate assets. So when we have real estate investors, which most of our clients are, we're going to be able to look at the income properties they have, how many properties. If you're showing an income of $50,000, but you own four properties in Southern Ontario, well, that's going to be a much different situation than if you're just a regular person earning 50,000 with no assets. So they'll look at that real estate, and we talk about these things, but we really don't on a day-to-day basis with real estate investors, business owners, or individuals, or high net worth individuals really come into a problem getting that higher amount. We almost always, I can't remember a time when we weren't able to get the amount that we wanted to, but that's goes back to behind the scenes and building the case, what we do. So yeah, real estate investors, we can get very flexible on contribution rates. Again, they're going to look at liquid assets and your properties that you have.
Yeah, for sure. And one other thing that we didn't quite mention just yet is that, well, we've mentioned before, is that with the infinite banking strategy, we're typically looking for the lowest death benefit. So we're maximizing our cash value. So it does take quite a bit to get to a lot of these maximums that we've talked about today. We're not always going for those huge amounts because we're looking for that smallest death benefit to put in place.
Yeah, like even on a simple infinite banking policy, if we don't even talk business owner and real estate investor, someone making 100 grand and they say, great, $3 million is the death benefit you're eligible for, and maybe in the infinite banking policy we only need $300,000 or $400,000 of death benefit because we're driving that death benefit down to drive the cash value up. Now, again, you can cover that difference with term insurance. That makes sense. We can talk about that in another podcast. But specifically with the infinite banking policy, the amount of death benefit we need is usually so small relative to the contribution that there's really not an issue getting that approved by the insurance company.
Yeah, and we talked about a lot of these different factors, and I don't want people out there listening to get overwhelmed thinking, okay, I got to look at my asset sheet, figure this all out. That is what we do, right? As specialists working with these policies, working with these individuals, real estate investors, business owners, we work on these regularly. So it's our job to sit down and talk to you and work on your plan and find out what works best for you, and then go back and take it to the underwriter and work directly with the underwriter. We might need to come back and ask you a few questions, but that's what we do best, right? This is what we do daily. So don't get overwhelmed with all the factors that we've talked about. At the end of the day, we're going to sit down and have a discussion and go through this together.
Yeah, and I mean, it sounds, oh, am I going to get approved in financial underwriting? Well, again, we don't have a big problem doing that, but we do all the heavy lifting. And what I mean by that, it's literally we're going to ask you maybe 2 to 3 minutes of questions on financial underwriting. We're going to say, what's your income you're showing? What's your net worth? What properties do you have? Do you own a business? What's your business worth? So we ask just some general questions, and then we can take that and we build the case, and we handle that, dealing with the underwriter and going back and forth with questions. So from a client perspective, it's not a concern typically for an infinite banking policy, and it's not a lot of work. It's just answering some questions when you're having a conversation with one of our team members.
Yeah, and we talk a lot about justifying it and making sure that we hit these factors. But at the end of the day, what the underwriter wants to see and what we want to see are all the same. We want to make sure that we are putting the best plan in place for our clients, the plan that's going to work for them financially, that's going to work for them long term. And the underwriter wants to see that as well. So we look at all these factors, but at the end of the day, we're putting a plan in place that's best for you.
Yeah, it's a win-win. The insurance company wins, and the client wins. So again, we don't have a lot of hurdles to overcome. But that brings up another point on multiple policies. So people will say, well, how many policies can I have? And I think last count I'm up to 8 now in my family. So there's no limit on the amount of policies, and we'll talk about why I have 8 in another podcast. But when someone has one policy and then they say, well, can I get another policy? The answer is almost always yes, and we don't have a lot of problems with that. But if you think of it, going back to the plain income test, if you make 100 grand, it's 30 times, you have a $3 million death benefit before we need to use any of the other factors to justify the death benefit. Well, an infinite banking policy may only require $300,000 or $400,000 of death benefit. So we're only using $300,000 or $400,000 because we're driving down that insurance death benefit to drive up the cash value, where we could have been up to $3 million. So if a year later someone comes in and goes, well, can I get an additional policy? Well, sure. We still have, $2.6 or $7 million of death benefit left based upon just your income. And again, we can get into real estate and business owners if that applies. So again, multiple policies, not a problem. Financial underwriting, typically not a problem. Anything else before we wrap up here, Christina?
The only other thing I want to add is that in our discussion today, we spoke about financial underwriting. So when we started discussing, I talked about that life insurance application where they're going to ask you medical questions, they're going to ask you some financial questions. What we cover today is the financial side of things. The medical questions are a different side that we will talk about in another podcast. We do need both to be done with the underwriting, but today we just touched on that financial side.
Yeah, absolutely. If you have 3 months to live, the insurance company's probably not going to insure you for $10 million. So that just makes sense. But yeah, and medical underwriting, we got a whole podcast planned on that and what we do behind the scenes to get the best possible outcome there. So that kind of covers financial underwriting. Key is deal with someone that's an expert at these policies, deal with someone that's used to building these cases, and typically we're not going to run into a problem because we're going to do all the heavy lifting behind the scenes. That's all we got for today. Thanks for watching. Thanks for listening. Have a wonderful day. Thanks for tuning into this episode. Don't forget to like, subscribe, and hit that bell button so you always know when new content is coming out. For more helpful tips and tricks, visit our Instagram, Facebook, or TikTok pages at Control and Compound. If you want to reach out to us directly or work with us, visit our website at controlandcompound.com. The links are in the show notes below. See you next episode.